Hi, Charles. Thanks for coming on.
Hey, Christine, how are you?
Good, good, good. I see 8 people online now. Oh, Nick says, "Good evening, Christine and Charles. You got another good one for your stream tonight." Oh, cool. Nick Nielsen was just on my show like I don't know 2 weeks ago. So thanks for joining in.
Oh yeah,
Okay,
awesome. Yeah, he's a great guy.
awesome. So why don't we get started by you introducing yourself? Like, what do you do? And I know you said you're a financial advisor and you also as a CFA. So maybe for people who doesn't know what CFA is, like, introduce like what you do exactly as a whole.
Yeah, so I started my career 20 years ago in investments in the late 90s. Actually in New York. I was originally from Central North Carolina, and so I've been involved in investments for a long time. And when I came back to North Carolina, I started helping my family with their investments. So there's sort of two paths. There's kind of the financial advisor, which can kind of help people with their broad-based planning and act as a quarterback and help them, kind of figure out how much they should be saving for retirement. Are they on track? If they need, what type of insurance do they need? Make sure their family is taken care of. And then also there's on the investment side for a portfolio manager. That's where sort of the CFA is. So I'm a chartered financial analyst, and that gets really deep into the weeds as far as analyzing specific stock investments or different areas of the market, such as stocks, bonds, commodities, and currencies. And so I feel like I've been fortunate in my career to have sort of been down both paths. And more of my passion is on the investment side, so that tends to be more of my focus. But because I still have my own planning practice with my friends and family, um, I think it kind of gives me a little bit of a unique perspective into helping connect, the specific investments with also the planning side as well. So.
Mhm. Okay. So for people who doesn't know what the CFA mean, I know it's a very hard test. I was looking into that before. I was looking CFA and CFP, and CFA is very hard. I know
Right.
people who try to do that. There's 3 levels, right? So why don't you tell people, what you specialize in? I mean, that's a really hard designation to get.
Right. Yeah, and so within portfolio management, the CFA designation is probably the most prestigious credential that you can get. There's 3 levels, and depending on, I mean, the pass rates kind of change from year to year, but to get through all 3 levels, I think the statistic is like less than 7% of all the people who start the journey actually finish
Mm-hmm.
the journey. So
Mm-hmm.
it was honestly, it was one of the hardest things I've ever had to do in my life. So I wasn't sure that I was going to get through it, but eventually I made it. And but it's incredibly comprehensive, and it covers all different areas of different types of investments. And I learned a lot, and it's been very beneficial for me.
Okay. So for the lay person who want to get into investments, like, I think like sometimes, I have clients coming to me or like, they just want to learn about how investments work. I don't give investment advice, whatever. So how can they get started? And then like what can they start reading about? Like maybe, they want to like try to learn, oh, is this whatever new company good to invest in? Are they worth investing in Etsy or Airbnb? Like how would you advise them on how to start just researching and just knowing if that's a good stock to buy? So I don't know if you pick individual stocks or you buy ETF or target funds. So I'm not sure how your style is.
hmm Yeah, my practice really revolves around investing in individual stocks and then also
Okay.
ETF. I don't use a lot of mutual funds per se,
Mm.
mainly because of the expense ratio, and
Yep.
uh, and also I'm the analyst, right? So I mean,
Mm-hmm.
if someone's investing in a mutual fund, you're sort of hiring someone like
Mm-hmm.
me to
Yep.
actually pick those funds, and
Yep.
and because I'm a CFA,
Mm-hmm.
I don't really use them, but
Mm-hmm.
um, but yeah, as far as getting started, there's a lot of great resources out there. I would say you do have to kind of be careful about some of the things you read on the internet because,
Mm-hmm.
not I'm saying that they're not true, because I mean, you can just find all kinds of things. And
Exactly.
investing can be very risky,
Yep.
and so you just have to be careful, and especially with individual stocks. I mean, one of the things I tell people is sort of a general rule of thumb is that investing in an individual stock is going to be more volatile than it would be with like an ETF, because
Mhm.
within that ETF you're going to have maybe 100 or 200
Mhm.
different
Yep.
funds or different
Exactly.
stocks. And so
Mhm.
if one stock was to fall, you might have another stock in that fund that goes up. So that sort of helps, manage that
Mhm.
volatility. Whereas if you
Mhm.
just pick one individual stock, then it could be much more volatile. So
Mhm.
people just have to be a little bit careful with going with individual stocks.
Mm-hmm. Got it. Okay, so what do you think of target fund? Like for a layperson, like can they just pick a target fund? Will that be okay? Like versus just I don't know, just let the money sit there and then like maybe that's less risky than or if they don't know how to pick an ETF, how to manage their portfolio or like pick individual stocks because that can be very risky. So is that fairly safe to just buy a target fund like Vanguard target fund 2050 if they're gonna retire in 30 years? So what do you personally think of that?
hmm I'll tell you actually a little personal story about target funds that I just ran into. So, one of the things about target funds that historically has happened is like the year would correspond like with the year they might retire.
Yep.
So, like 2030 fund means that you're going to retire in 2030. Well, I was actually sitting down with a friend of mine. His sister was looking to retire in 2 years, and she was in a 2025 fund, which made me think, okay, well, my assumption was that it might be pretty conservative because, it's just a few years away from her potential retirement. And she wanted to retire a little bit early. But when I actually looked at the investment breakdown of the fund, there
Mhm.
was almost 70% of the fund in equities and stocks,
Mhm. Mhm.
which is fairly aggressive for her, she was already in her late 60s. And
Oh.
so, and one of the things that, and after doing a little bit more research, some of the target fund companies now are not looking at the date as a retirement date. They're actually looking at the date as a longevity date. So
Mhm.
their argument is that, your life expectancy might run out, down the road. And so, you need a higher amount of equities to basically last 30 years in retirement. So the
Mhm.
argument is okay, well, it's still okay for her to have that amount of equities, even though because she might live to 95. And
Mhm.
that was so my opinion of that was that was a little too aggressive for her, given she was entering into a point where she's going to be needing to draw that
Mhm.
money out or start
Mhm.
taking withdrawals for her retirement. So I think you just like with target date funds, I think you just have to read the fine print and
Mhm.
see exactly, okay, how are they basing that allocation within the fund,
Mhm.
because it's I think it's changing from what it used to be. So does that make
Mhm.
sense?
So you're saying that when they're closer to retirement, you would want them more to have bonds. Like for example, they're retiring in a year, so you want them more. Typically, how do you allocate it? Like 50% bonds already or 70% bonds?
It's a really that's an excellent question because
Mhm.
of basically where the bond market is right now.
Mhm.
Historically, when you sort of thought about that, is the asset allocation would sort of shift more towards bonds, like you were saying, because bonds have tended to be safer investments. You get a guaranteed, you get the income off of them, and they're not as volatile as stocks are. But one
Mhm.
of the challenges now with the bond market is that interest rates are basically at zero. And
Mhm.
so the challenge is when interest rates rise, your bond principal goes down.
Mhm.
So it really makes someone like me, you almost have to rethink what does it mean to have a defensive part of the portfolio. So I've actually been
Mhm.
doing a fair amount of research and trying to look at, okay, how would I build a portfolio for my aunt or an advisor
Mhm.
that works with me, who's hired me to be their chief investment officer. How am I going to build that portfolio given where the bond market is, to meet the needs of that person in retirement. So,
Mhm.
because it's very different than it was, 20, 25 years ago because of where rates are.
Yeah, so let's say when someone's already retiring already, so is that income, I mean, preservation to just have bonds, or you're still not sure? That's what you're still trying to figure out for someone who's already currently retired. So you just don't want him to have too much equity, then it's more bonds for someone who's like retired now or next year.
hmm Yeah, I mean, I think especially where the market is right now,
Mhm.
because I do a lot of work in valuations, and sort of a fundamental principle of finance is that if you have high valuations, with the stock market, your future returns should be lower, and vice versa. If
Oh.
you have low valuations, future returns are likely higher. And I mean, J.P. Morgan actually has a really good chart that shows that. And and so one of the things about where the market is now is valuations are very, very elevated. Um,
Mhm.
and so that would suggest that future returns are lower than they have been over the last few years, especially. So I think for somebody when they're entering into retirement, that's a real important consideration, and the main reason is because of sequence of return risk. So and so what happens with sequence of return risk is, if I was to let's say retire and I'm 66 years old, and the
Mhm.
market is at a really high valuation, kind of like it is now. Well, if we were to get a crash like we got in, let's say 2000 or 2008,
Mhm.
if the market goes down significantly in the first several years of your retirement, right at the
Mm.
time you're taking
Oh.
withdrawals, so your withdrawals compound the loss, because market brings your account down and you're taking money out at the same time. So
Mm.
even if the market recovers, at
Yeah.
some point down the road, because you're still taking,
Oh.
it can destroy your account over the long term, and you might actually end up running out of money. Um,
Yeah.
so sequence of return risk is a really big deal
Mhm.
right now because of where the market is. So for anyone, any viewers who may be
Mhm.
close to retirement, it's something to really keep in mind.
Okay, we'll talk a little more about retirement. But Jonathan has two questions here, so he's excited and asking questions. So his first question is, "What is your opinion of cryptocurrency?"
Oh, Jonathan. Okay.
Got
So
put you on the spot there, right?
That's right. That's right. So I'm honestly not a big fan of cryptocurrencies, and the main reason is, a currency by definition is a store of value, and
Mhm.
so like for the U.S. dollar, I mean, it's a piece of paper that says, this is worth $1, and it's backed up by the federal government. Whereas, something like Bitcoin, there's really nothing backing up that value. And so, for me, I don't feel like cryptocurrencies um, are I just don't trust them, I guess, is probably the best way to say it. Now what I do think is valuable is the technology behind the cryptocurrencies, the blockchain technology. And
Mhm.
what I could potentially see in the future is a country using that blockchain technology to create a digital currency, and then
Mhm.
saying, okay, here's a digital currency, and we, as a certain country, we are going to back that value up. And that's
Mhm.
a different situation than what we have now. So I am not a big fan of cryptocurrencies as they are at this time.
Okay. Me too. I'm not a big fan as well. So what do you think of forex? Because we're talking about cryptocurrency. Do you use
So
that?
yeah, so it's interesting because I think that forex can really be an important contributor to a portfolio,
Mhm.
especially nowadays, because as I was talking about with the bonds, one of the things that I've actually been doing with my recommended portfolios is looking at currencies as a diversifier, and they can actually be defensive, depending on which currencies you're picking. So, one of the things about trying to find diversification within your portfolio is you want to look for something that might have a zero or even a negative correlation, to stocks. Because if we did get a stock market crash, maybe you have a currency investment that might go up even as stocks are going down. So which, helps
Mhm.
moderate that volatility. So I think, currencies, can definitely do that.
Got it. Okay. So, okay, Jonathan has another question. Traditionally, 100% equity portfolio would be considered risky for retirees. What is your opinion of that, considering bonds are paying less than 1%?
I still think the main thing about, especially for retirees is, the problem is when you're younger, you're in what's called the accumulation phase. So you're saving,
Mm-hmm. Yep.
for your retirement,
Yep.
and if the market was to take a big drop, let's say you're in 100% equities and the market goes down, 50%. It's not as big of a deal because you're putting in your monthly contributions to your 401k, and
Yeah.
you're sort of steadily dollar cost averaging,
Yep. Yep.
and building back up, right?
Mm-hmm.
But when you hit retirement, that's a totally different issue, because now
Mm-hmm.
you switch from accumulation phase to distribution phase.
Yep.
And
Yep.
so now you're saying, okay, well, I'm going to start taking some systematic withdrawals. And you probably have Social Security. Maybe you have a pension, maybe.
Mm-hmm.
But more and more people are relying on investment accounts, to provide income for their retirement.
Yeah.
So risk management is a huge, consideration for retirees,
Mm-hmm.
especially as, again, like I said, where valuations are with the market. So when you're 100%, in equity, I mean, you got to know that there is a possibility that you could have a 20, 30. I mean, even earlier this year, we had close to a 40% drawdown, in a month. And so, if you were 70 years old, that's a big deal. Now, granted, it came back, but here's the other thing, and which kind of, something else I've worked on is, I've been doing a lot of research on behavioral finance. And one
Mm-hmm.
of the things that I've looked at and studied is that, so if you look back at like a buy and hold strategy, where
Mm-hmm.
you just buy, like, I'm just going to let it ride no matter what. If you look
Mm-hmm.
at that over the last 30 years from a pure return
Mm-hmm.
standpoint,
Mm-hmm.
there's no other strategy that beats that as far as a return.
Mm-hmm.
But the problem is it's not realistic for an average person to achieve, because what happens is when you start seeing your account drop, like what happened in 2000 and in 08, 09, you see that and you see your account basically get cut in half. You start
Mm-hmm.
panicking, because if you're in retirement, that's your life
Yeah.
savings that just
Exactly.
went down 50%, right?
Yep. Yep.
And you don't know when it might come back.
Yeah.
It comes back. We've been incredibly fortunate over the last 6 months, and none of, I would say, I don't know of very many of my peers that I converse with on Bloomberg that would have ever thought we would have come back so far so fast. And so I think, on a for an average person, I mean, the chances of making a mistake and saying, I'm really scared, I just can't lose anymore. The emotions take over, and then they pull the money out, and then that might be at the actual bottom, and then they miss,
Yeah.
the up.
Exactly.
So there's just staying 100% equities can be challenging for a lot of reasons because of those types of things.
Yeah. So okay, there's a couple more interesting questions there. So yeah, people are loving this. So I was just so you're saying that the more, I guess, people actually Dallas asked a question. So that's why as you age, you move investments into less volatile instruments, correct? So how do you typically do that? So I guess like let's say 100% stocks. So when would you suggest someone to start getting, lower and lower in stocks, and what is the what is the less volatile instrument as they closer to retirement? How would you go about doing that?
Hmm. So that's where I think, the financial plan
Mm-hmm.
is a huge contributor to that decision. Because, one of the things, the values of a financial plan is that, you can kind of figure out, whatever your lifestyle is, and whatever your nest egg is, you kind of compare those, and like, one of my clients, it's interesting because they worked at a tobacco manufacturing plant here in North
Mm-hmm.
Carolina, and they both worked, on the factory floor. So they were, they didn't have huge incomes, but they have small pensions from the plant, and then they have Social Security, and then they have, their nest egg, which is, about $400,000. But that's all the money they have. Well, when I asked them, I was like, well, what is your spending now that you have retired? And they came back and they said, what's about $2,500 a month? And
Okay.
I was like, okay, are you counting, that trip to the beach? Are you counting Christmas presents? Are you counting, property tax, things that might only
Mm-hmm.
come once a year? And so they
Mm-hmm.
came back and they were like, well, maybe $2,800 a month, after everything is kind of said and done. Well,
Mm-hmm.
one of the things about it was their Social Security and pension covered that expense. So they weren't even withdrawing money from their, or needed to withdraw money from, from their 401ks, which we moved to an IRA. But so it kind of varies. I mean, so if somebody is going to start, withdrawing from that pretty regularly, and depending on how much they need to withdraw for their lifestyle, then that can
Mm-hmm.
kind of dictate how much volatility they can handle. So I think it's really critical to for an advisor, especially, to talk with them about their plan, what their needs are, and then they can kind of make the appropriate,
Mm-hmm.
adjustment from there. So,
Okay.
and the other part I would say is it just depends on their, propensity to take risk, because, again, if they're trying to younger and like maybe early 60s, but they're going to do some consulting and they want to kind of work part time, and they're still okay with taking some risk. Well, then you may not have to dial it back as much. So it just depends on, I think, the client situation.
Okay. So what do you think the less volatile instruments are now? Because you said stocks is quite risky. So so bonds is one of them, but then like what are other less volatile instrument that that you
Mhm.
usually use?
Well, to your point earlier, I've actually been looking at currencies as,
Oh, okay.
supplement. Like, one of the ones that I think is pretty attractive now is the Japanese yen, which tends
Okay.
to historically has been sort of a defensive currency.
Mhm.
And the dollar, the dollar is looking like it's broken its 10-year sort of uptrend, and it's sort of started a new downtrend, which suggests that, foreign currencies should be appreciating relative to the dollar. So,
Mhm.
so that's something I kind of look at. But if you look at kind of the volatility of different currencies, especially in developed markets like with the euro or the yen, you don't get the same kind of volatility. Now, if you start getting into more emerging market currencies, as an example, then you can get more volatility. But
Mm.
staying with things like the yen or the euro, can actually provide some diversification. Um,
Oh,
you know,
okay. I didn't know that. So how do you buy into forex? Like how do you do that trading? Can you buy ETF for that or?
that's actually what I do for my clients. There's
Oh,
several
okay.
apps that you can use to do that. Hmm.
Got it. Cool. Okay. So OJ has a question. Will you cash out on individual bonds since the returns are low now?
That's a good question. So it depends probably on, when you got the bond. I mean, like with individual, what I've been telling people now is, what you got to really be careful of is bond funds, because with bond funds, they're sort of constantly turning over, the bonds back and forth. So as interest rates go up, the bond is going to take a hit. If you're going to do bonds, to OJ's point, like building a bond ladder probably makes more sense because you're going to hold that bond to maturity, like you're going to buy it and then hold it to maturity, so you'll get that
Mm-hmm.
yield. Whereas you're not going to sell it before it matures, because if rates go up, then the price of that bond is going to go down. So, then that's kind of the idea, is that when in a rising interest rate environment, you want to hold those bonds to maturity. Um, so
Okay.
it kind of depends on what the specifics are for that bond. It would be hard for
Mm.
me to say uh,
Yeah.
exactly.
Do you typically buy the bonds as an ETF or you just buy directly?
So I've done both, but I've been recommending doing the ETFs for
Mm.
bonds lately.
Got it. Okay. So let's talk about the valuation that you're talking about. So where are you managing investment expectation based on where the market is at a certain time? So how do you do valuations?
Mhm. So I kind of look at valuations on a number of different levels. One of the most common ways to look at evaluation is a price earnings ratio.
Mm,
And one of the things that I look at is I look at a 3 year kind of rolling average. So I look at, and the reason I do that is because it sort of accounts for the trends that are going on in the market. Now, so I'll look at that average, but then here's the thing that's really interesting, is that you remember the bell curve, from like statistics class, where you
mm-hmm.
have
Yep.
like the bell.
Yeah.
So the average is like in the middle, right? And then
Mm-hmm.
you plot out like +1, +2, +3 standard deviations away from that average. And so, like the +2 is your 95% confidence interval. The +3 is your 99% confidence interval. And so
Mm-hmm.
the observations, are should be within that bell, right?
Mm-hmm.
So what happens is, if you overlay that with a price earnings chart, what I've found is that when you have earnings price earnings ratio hit those extreme levels, like if it's trading in the +2 or +3 standard deviation, that's an extreme level. So you tend to see a reversion back to that mean. And it
Mm-hmm.
happens both ways. It happens on the downside and on the upside.
Mm-hmm.
So if like back when COVID hit, markets were tanking, and the S&P actually hit below its second standard deviation. So, and then we actually saw it bounce right back up. Now, what's
Mm-hmm.
interesting is, since that's happened, we're actually in an extremely overvalued situation that's been persistent. So I mean, it's not a black and white kind of situation, because
Mm-hmm.
the narrative of the market can really make an impact, and the
Mm-hmm.
stimulus that the Federal Reserve has injected into the market, I mean, that has inflated assets, and I think kept valuations very high. But to me, whenever I see valuations in that sort of extreme range, it's just a gigantic red flag, and says you should maybe be a little more cautious.
Okay. Yeah, that sounds good. Okay. Dallas was saying I use an ETF for the bond portion of my portfolio and consider the dividend there my risk-free rate. Probably not the right way to do it. I don't know if you have any comment with that.
Yeah, I don't know. I don't know that I would say that's kind of the risk-free rate. Because also, it depends on if it's like, is it like a high yield bond? Is it corporate bond? I mean, the risk-free rate is generally looked at as like a government, bond. So like the 10-year, government is really kind of looked at as like a risk-free rate, because
Mm-hmm.
risk-free is like, what's the probability of default, of the U.S. government?
Mm.
Probably not much. So that's that's what I would probably consider more of a risk-free rate.
Yeah. Okay. So I know okay, I know you were talking about earlier, Charles. Like so for that the example that you gave earlier, that if they have a pension, social security, they're not even getting the money out from their IRA. So what if for other people, like I mean, most people, I feel, they only have the retirement fund or investments and savings. So let's not include rental property. Let's just talk about, like, I think generally most people are just this, right? So
Mhm.
then so let's say they're gonna plan to retire next year. So is it like, I mean, is it safe to just have to, like, maybe you have 2 years to 3 years worth of savings there, so that way you can kind of like, make sure, I mean, and then like when the market is up, you can kind of replenish that to make sure it's always 3 years. Then at least you have time for, like, in case the market goes down, then you have time for it to recover a little bit. So you're not like, panicking. Let's say you don't have pension, you only have social security. Hopefully social security is still there, and then they
Yeah.
only have that savings and the IRA or 401k traditional Roth, and some investment brokerages. So that's the only thing they have. So is that smart to do it that way? Maybe just make sure they always have 3 years worth of savings all the time, and then just kind of sell slowly, from that whatever retirement accounts, and then to just replenish that, to just make sure you always have 3 years to 5 years savings all the time.
Yeah. Yeah, I think that's a great point actually, because I mean, one of the things about the sequence of return risk, that I
Mm-hmm.
was just talking about is, if you're dependent on, if you don't have that, so now you're dependent on taking those withdrawals, out of the account as the market is going down. So it's kind of the double whammy on your investment account. So if you have a place like that where you can say, okay, well, market is down, we want to not take that. I always use the three bucket analogy.
Okay.
Whereas the first bucket is your checking account, your savings account, maybe a
Mm.
money market. Your middle bucket is like a taxable investment account. Your third bucket is your retirement accounts. So if the maybe you're switching to a different bucket during those times where you have a big crash in the market or a big downturn in the market. To your point, so you're not selling when the market is down. You're,
Mm-hmm. Yep.
you're allowing it time to recover,
Got it.
um,
Yep.
to do that. So I think that's a great idea.
So let's repeat again. So you said three buckets. So the first bucket is the checking savings. What do you call that?
Yeah, I just call it bucket one.
Okay, bucket one. Okay, then the bucket two is what's in that.
So that's like a taxable investment account.
So that
So
will. Oh, go ahead.
yeah, yeah. So just a regular account. So where you're going to pay, you might invest that, in some ETFs or individual stocks, but it's
Mm-hmm.
almost like a rainy day fund, whereas
Mm-hmm.
we don't need that money today, and we don't. It's not an
Mm-hmm.
emergency fund.
Mm-hmm.
Like bucket one could be kind of your emergency funds. It's sort of bucket two, in my opinion, is kind of a rainy day fund where maybe you're saving towards a certain goal, and you don't need the money right away, but you want to make more than what you would make, at the
Mm-hmm.
bank.
Mm-hmm.
So you're willing to take a little bit more risk to get a little
Mm-hmm.
higher return.
Mm-hmm.
Um, but the thing about bucket two is it's liquid, so if you need the money, you can take the money
Mm-hmm.
out and there's no
Yep.
penalties or anything like
Mm-hmm.
that.
Yep.
And then bucket three is where your uh,
Mm.
retirement accounts are.
So taxable, that would be all the individual brokerages, right?
Right,
Okay,
exactly.
and then the bucket three, and Roth can be under here too, because, oh wait, that's not taxable. So but then the retirement, so that's traditional and Roth, so that will be kind of different as well in terms of how they're taxed. So you're saying, so for people who are retired, their bucket one, yeah, I guess it's safe to just do 3 years to 5 years, so they can kind of ride the market. If the market goes down, they can't touch bucket two or bucket three because it's in the market, right? So I guess
Hmm.
when the market is okay, then they can kind of touch those two, and then, like, kind of replenish that bucket one as the market is up, right?
Right.
Yep.
Yeah, yeah.
Okay.
The challenge about bucket one is, because you really can't earn anything because interest
Mm-hmm.
rates are so low right now. I mean, you basically get very little on even like a CD rate. I mean, you just don't really earn very much. So, you know,
Yeah.
to have a whole lot of money, there it's a little bit of a balancing act to try to get. And I think that's actually what we're seeing in the market is, you have people
Mm-hmm.
that traditionally would be looking at bonds as an investment, but because bonds have been artificially pushed down because of the Federal Reserve action,
Mm-hmm.
um, people are almost being forced to take on more risk, and invest in stocks when that may or may not what be appropriate for their situation. And so,
Yep.
so it's a challenging environment because of that.
Yep. Awesome. Um, Okay, so do you have any more suggestion charts for people who are I guess getting into the investing thing? These are all very interesting. We can talk forever about this, but I don't want to take up too much of your time. So what suggestion do you have for people, I guess, if they want to try to get into investing?
One of the best resources when I was early in my career that I
Hmm.
felt was it was a newspaper called Investors Business Daily. Um,
Oh, okay.
which
Hmm.
I'm certain is I don't actually I'm not a subscriber anymore, but I read it for years and years and years, and especially when I was in New York. I mean, it was I would get it every day, and the greatest thing about Investors Business Daily was not only did it give you the news of the day and what was going on with the markets, but the founder of the company has written several investment books and written, kind of, it's called, actually, I've got several editions. It's called How to Make Money in Stocks. So
Hmm.
there's a lot of education tools that are not only
Hmm.
within the paper, but also, I know on the website,
Hmm.
and a lot of them I think are free to people,
Hmm.
to help,
Okay.
help you understand the market and how it
Hmm.
works, and also give you some guidelines about what to look for, how to read charts, things like that.
Hmm.
So that's one of the best tools that I was able to find when I was first starting out.
Got it. So Dallas made a comment. OJ, I wouldn't everything else on the market is so expensive right now. Your bond is undervalued. Guess bond is undervalued right now.
Yeah, well, bonds are actually, overvalued right now because,
Mm,
again, with a bond, so there's an inverse relationship between rates and bond prices. So when rates go down, bond prices go up.
mm-hmm,
And
mm-hmm,
so that's one of the things is that, as rates are sort of being pushed down, bond prices are kind of going up and up and up. And so
mm-hmm,
that's kind of one of the challenging things about this environment is that again but bond rates have really been going down for 50 years. I mean, all going really all the way back to
mm-hmm,
the 80s, 70s and 80s when Paul Volcker had to jack up interest rates to break the inflation of the 80s. Well, really, if
mm-hmm,
you look at a chart of interest rates, they've been steadily going down ever since that time. So but now bond rates are down basically at zero. So, what's the probable path going forward? I mean, places like Europe have experimented with negative interest rates, but it's really not gotten it's not had the intended consequences. So it's sort of an experiment that's failed. So, that we've decided sort of not to do that. Powell has said, he is not interested in, bringing negative interest rates to the U.S. So we're either kind of staying at that zero bound, or if we start to get a pickup in the economy, then we should start seeing interest rates go back up. Well, if interest rates
mm-hmm.
again are going back up, then bond prices are going to go down. So
Uh,
so that's where you kind of have to be careful with, bonds for sure.
got it.
And
Yeah.
that's what, I was saying earlier, like, if you think of a traditional, like a 60-40 or 50-50 portfolio where you
Mm,
have half
yep.
stocks and half bonds, you really have to almost have this alternative thinking now of, okay, well, if bonds are not the greatest investment, what are some alternatives?
Yep.
And there are some things that, within the bond world that you could sell, like floating rate bonds or tips, things like that, where the interest rate adjusts as it goes up. I mean,
Mm,
that's certainly a consideration, but certainly like things like long duration bonds, you I would say it's not worth the yield pickup to do that, because you get a lot of risk on the principal side. So.
got it. So what do you think about other stuff, for people like owning rental properties, the life insurance or whole life? or and the annuities as part of their portfolio? What's your personal opinion on that?
So the thing about properties that I think rental properties can be great investments. There's sort of two things to think about. One is how easily can you rent that property. My
Hmm.
dad actually had an experience.
Oh,
He bought two condos one time, and
uh,
he had a difficult time. Well, one,
yeah,
he couldn't find renters, and then the renters that he had were very difficult. So, so if you can find
yeah.
good renters, then rental properties can be great. Um,
Okay. Yep.
but the other thing about that is liquidity, because if your
Yep.
money is tied up within property, sometimes it's not as liquid. So if you needed money quickly,
Yep.
you may or may
Exactly.
not be able to get to it. So liquidity can be an issue.
Yep.
Life insurance is interesting because there's probably not very many CFAs that would have favorable opinion of life insurance, but I actually
Hmm.
do, because one of the things that I've seen in my career, and actually the company that I worked with when I came back from New York was called AXA, which and they do a lot of insurance and life insurance and annuities. And
Hmm.
when I've been talking with people over the years, there's some people, as an example, who they don't have a pension, so they
Oh,
don't have
yeah.
a guaranteed income. And
Hmm.
and one of the things is like, okay, like an annuity, you could say, okay, well, yes, the expenses are higher, absolutely, and you want to be very transparent about sharing what those costs are, but
Hmm.
to get that guaranteed income, the annuity company is going to basically give you a guaranteed income for the rest of your
Hmm.
life. So
Yep.
you're creating your own pension out of, like, let's just say your 401k.
Hmm.
And so a lot of people find value in having that security. So
Hmm.
so I think it really depends on the situation again, and that's
Hmm.
where financial advisors are so valuable, because they can talk to you and they can look at where you are in your life and what are all of the different things that you have, and they can make sort of those appropriate recommendations, to say, hey, well, did you know you could actually get a guaranteed income, through by doing this, right? And this is kind of how it works. So I think annuities definitely have their place. I think life insurance absolutely has its place in a portfolio. I mean,
Okay.
the biggest asset that you have is your ability to earn an income, right? And
Yep.
so, like, I'm 46 right now,
Hmm.
and if I passed away in a car wreck next week, I mean, what's the future value of my income over the next 50 years? You know what I mean?
Hmm.
Like,
Yep.
all of that is actually gone, you
Yeah.
know, in a blink. So that's the kind of thing where, life insurance can help you if you're not there for some reason, to earn a living to take care of your family. Life insurance can be there to help take care of
Hmm.
your family. So
Yeah, and then if you don't have kids, or like if you don't have pension as well, then I annuity, I guess, will kind of give you peace of mind that okay, you might have a like income coming in all the time, that you don't have to worry about managing or how much in your savings, whatever. So for some people, it's probably a good thing. Okay,
yeah,
so Dallas, yeah, Dallas said, what about universal life policies?
yeah. Yeah, universal life policies, I think can be good. One of the things you want to always do with any policy is sort of look at what the terms are, and what the assumptions are. One of the things about universal life that, at least back in the day, was a real issue, was how those interest rates were quoted on an illustration. So, like, a life
Hmm.
insurance agent might say, here's a universal life policy, and we're going to project, we're going to show you the cash values based on a 6% interest rate, for the
Hmm.
rest of their life of the policy. And
Yep.
I love Anthony Ruffalo's, comment to this, because he and I have seen stuff like that.
Uh-huh.
And the problem is well, what happened is so the life insurance person might have been, using that rate, but rates have dropped. I mean, dramatically. So, the assumption in the illustration, was not accurate. And so what happens is now, 30 years later, when it didn't get those interest rate, now there's not been enough cash put in the policy, and so now the policy is at risk of lapsing because the assumptions were wrong. And so, that's one of the challenges with, those life insurance illustrations is you want to make sure that the assumptions that you're using in the illustration are pretty reasonable. So just something to keep an eye out for.
Got it. Cool. Also, I guess we didn't explain. So, what is universal life policy for people who don't know?
So universal life policy, it's basically a permanent life insurance policy, which means,
Mm-hmm.
part of your premium is going to cover the cost of the insurance. And then
Mm-hmm.
a part of the premium is invested in creating a cash value. And that cash
Mm-hmm.
value is then reinvested, by the insurance company. And you're subject to earn a certain interest rate on that cash value. So the idea is that you're kind of get the insurance. If something happened to me next week, then I have the face value of the policy that would pay out to my beneficiary. But if nothing happened to me and I lived a long and healthy life, then I still have this cash value that's growing, which if I ever canceled the policy for some reason, I could get the cash value back, or
Mm-hmm.
and sometimes you can actually access the cash value in the
Mm-hmm.
form of a loan. So actually, Christine, to your point earlier about what kind of places could you go to actually access cash in a market decline? I have heard of
Mm.
people looking at life insurance cash values as an alternative to
Mm-hmm.
possibly access income during a market decline, so they didn't have to sell, when the markets were down. So it's kind of an alternative sort of source of temporary income.
Got it. Cool. So this is all interesting. So Charles, how has LinkedIn helped you? And then we can end this with how people can find you.
Yeah. So LinkedIn has actually been pretty amazing for me. For the longest time, I have felt like I didn't have a voice, like
Mm.
and one of the things that I've sort of discovered with social media is that it's a great way to share my ideas and thoughts. And like, I spend, I do my research on a Bloomberg terminal. And, so I'm constantly, researching things and thinking about ideas and thinking about where the markets are going. And LinkedIn has been this forum for me to say, hey, did you guys know this was going on with inflation? Or hey, did you know valuations were at this level? Oh my gosh, like that's a really kind of a red flag. We should think about this. And so not only have I been able to kind of share my research and my thoughts, but I'm getting engagement from other
Mm-hmm.
professionals who say, well, hey Charles, what do you think about this? And have you thought about that? And I'm like, oh, actually, that's actually a really great point, and it may be something that I've never considered before. And like there was one guy that I mean I'm connecting with people, not only in the United States but in Europe, in Australia, New Zealand, South America. I mean, it's pretty amazing that I mean these are people I would have never had the opportunity, being in Central North Carolina, to
Yeah,
connect with somebody,
exactly. Yep.
like we would have never been able to cross paths, but he could see
Mm.
a post that I've made and say, hey,
Yeah.
that's a great point. What do you think about this? And so LinkedIn has just been really a great tool for me to kind of engage with other professionals in finance. So I'm real thankful for.
Exactly. Awesome. Okay. So okay, that's it. Thanks for hosting this for us. You're very welcome. And then Charles is awesome. So yeah, how can people find you? And then versus LinkedIn. And then when, are you open to people reaching out to you and stuff like that?
Yeah. Yeah, so
Mhm.
my website is www.adaptfirst.com. And actually, I write a weekly blog. I put my blog right on the
Oh,
homepage.
okay.
Um, so if you kind of want to see some of the things that I'm thinking about or researching, I have that people can subscribe to. And I'm actually doing two kind of interesting things for financial advisors. I with my firm, several friends of mine have asked to sort of join my firm, and so I've opened it up to having advisors join me. And then the other thing that I sort of mentioned earlier was that I've had advisors kind of enjoy my research and my posts, and they've asked if I could help them, sort of directly. So I call it an outsourced chief investment officer because
Mhm.
I'm not actually working directly under their firm. They're sort of hiring me as an outside consultant, and I've been able to help them build portfolios and answer questions, that their clients may have. And even some of them, the XY planners, they're looking to bring me on calls to help build their practice. So yeah, and just being a resource
Uh,
advisor is it's really cool. So I'm
uh,
excited about it.
so Anthony just popped up and said, "Who is the best looking advisor, Charles?"
It's actually Keith Wilson. So it's
Who's Kid Wilson? Should I have it on my LinkedIn live now so I can have good looking advisors on my LinkedIn?
uh, Wilson on it. Don't have any Ruffalo because he'll be
No. Oh, I'm still waiting for Anthony to set up a LinkedIn live. Yeah, Anthony.
he
Set
might
up
wear
the
a
link.
yellow tracksuit, so you don't want that guy.
Cool. Okay, this has been really fun, Charles. I really appreciate you sharing your time and your knowledge. So yeah, so thank you so much for joining in. So yeah, and I know it's probably late on your end, so I really appreciate this. So and I'll
Yeah,
convert this to a podcast because I think we covered a lot of good stuff. So for everyone who doesn't know, I do have a podcast. It's on iTunes, Spotify, everywhere. It's called Life and Money with Christine Tay. So I'll upload this as the next episode because there's a lot of nuggets about investments to learn. So
yeah.
thank you so much, Charles.
Yeah, thank you, Christine. Great
Okay,
to
have a
hear.
good night.
So
Bye.
thank you.
Thank you, everyone.
Bye.